Many of you asked me about my opinion on REITs. What are my favorite REITs in the stock market right now? And what I think about REITs in general. Are REITs a good buying opportunity because we have high interest rates? And if interest rates come down, REITs will likely get bid up. So you're getting multiple expansion, all that kind of stuff. And I do agree, and I've been saying it for a while, that REITs to me have been a good buying opportunity for a while. I've been saying it. I've been mainly bullish on apartment REITs, Avalon Bay Communities, and Mid America. Mid America looks like it has bottomed. It's up around 12% from 52 weeks low, and it's been making higher highs and higher lows, and that's a pretty bullish pattern. So maybe it's already starting to play out. That's amazingly well. So I'm going to talk about two other ones here. And I do agree that REITs are a good buying opportunity, and you're getting paid a pretty decent dividend while you wait for interest rates to ultimately come down. And then you have a recession indicator, which is a 10-year minus 3 months. It's signaling a recession. Every time it goes negative, then it goes positive. We have some kind of a recession. If you just look at shaded gray area, and it looks like it's going to happen again, and we're likely going to turn positive from now to 2025. And once the recession narrative begins, this is when investors tend to chase yield. This is when they chase REITs yielding 5-6% dividends. This is when they chase Pepsi, McDonald's, all the safety stocks that are crashing. I mean, I'm extremely bullish on them, and the upside potential is going to be amazing once the recession narrative starts. And I think it's going to happen very, very soon. Now, the first stocks I'm going to talk about, I'm not going to waste your time on it because a lot of you know the stock. I talked about it. It's a popular one with retail investors. It's VC Properties. It's $27.83, right at 52-week low. It's down pretty close to 15% year to date. Now, this is a company that has trophy properties on Las Vegas Strip, one of the best amazing high quality properties that you could ever dream of, from Park MGM and Luxor and Mandalay Bay and Caesars, and so many properties on the Las Vegas Strip, and even outside the Strip and outside of Vegas. They own a lot of such properties. Pretty amazing stuff. The best part about the business model is they have very long-term leases. Their weighted average lease term is 41 and a half years. 41 and a half years of leases. This is absolutely insane. For MGM, it's 51 years of leases. So there's a lot of visibility. It's a very safe stock. I've been saying it for a while that VC to me is easy money. I mean, you get paid a decent yield that I'm going to discuss while you wait for interest rates to come down. It's been easy money, and I continue to say that. And it's a good company, amazing company. I really like it. And VC is a fast dividend grower. They grow the dividend in terms of a compounded annualized dividend growth rate of 7.9%. This is much higher than ADC, which I also liked, 6.1. ADC has been doing well. Stocks like Triple Net, Realty Income, VC is the highest at 7.9%. Very good stuff. Now, the problem with their leases is, yes, it's amazing that they have 41 and a half years of lease term, amazing stuff. But the problem is that not all of it is actually indexed to inflation or indexed to the CPI. 50% of it right now is indexed to the CPI, and that's a good improvement. And they're working on increasing it over time, and expected to get to 96% by 2035. And that's going to help over time, but for now, only 50% is. And maybe this is an area of concern, and you have to keep it in mind. For the dividend, it's around a 6% dividend, the highest it has over the last, since 2021, 6% dividend. A very good dividend in my opinion. But you don't only get the dividend, you also get some kind of adjusted fund from operation per share growth, which is a metric. The best metric to use with REITs is AFFO per share, not FFO, not net income, not free cash flow. It adjusted fund from operation per share is the best one. And you could see 3 to 4% of AFFO per share growth. Now, the company used to grow 10 and 11%. It might be able to do it again, but I wouldn't personally bet on it. I wouldn't bet on it at all. I don't never bet on the best case scenario. I always bet on the mid to worst case scenario. And I think I could easily see 4% on average AFFO per share growth for VC. So you're getting a 6% dividend, 4% AFFO per share growth. This is a 10% annual return on VC. As I said, the stock is easy money. But the only problem is that everyone knows that VC is safe. Everyone knows that VC has 41 and a half years of leases. And this is why the stock is not a huge bargain relative to its past. Relative to its past, it used to trade at a mean multiple of 14 times price to AFFO per share. It's now trading at 12 times price to AFFO per share. So best case scenario, you could get a multiple expansion back to 14 times. The highest it has traded at was like 18 times So I wouldn't bet on it. So yes, you will get a multiple expansion, but it's not going to be anything meaningful. But you will get a 10% return to get paid while you wait for interest rates to come down. When they come down, you can get a slight multiple expansion, and maybe you could get 12, 13% total return. But with VCs, the company itself, with the long-term leases, I really like it. I still believe the stock is easy money if you're more of a conservative investor and you want looking for a place to park cash or even to bet on lower rates. For me, I would rather bet on REITs instead of TLT. I'm just being honest. I like REITs much more than TLT, and I believe they're providing the same exact exposure. Now, the second stock, which I haven't discussed in a long time, and I was bullish on this one too, and it's mainly realty income, ticker symbol O. It's down 9% year to date. It went up a little bit from 52-week low. I remember it went as low as 48. I don't know why I can't see it, but I remember it going to 48, 47, and now sitting at $53. Realty income has a pretty good tenant base. But I said it before, I'm going to say it again. I'm not a big fan of Walgreens, Dollar General, Family Dollar, and Dollar Trees, the dollar stores and Walgreens. I'm not a big fan of those tenants. I did mention before that I went on a triple net website and I was looking for properties to buy. And then I saw a lot of the institutional investors and investors in general, they're dumping Dollar General and Walgreens like never before. Like just you go on the listings, everything is pretty much either Walgreens or Dollar General. It was absolutely insane at much higher cap rates than other REIT properties. And recently, Walgreens has announced is closing thousands of stores by 2027. I believe it's 25% of their total stores. Of 8,000 stores, they're going to be closed by 2027. And Realty Income does have exposure to Walgreens. The good thing is it's been coming down because they did many more acquisitions in terms of the Bellagio, which was an amazing acquisition. I loved it. And many different acquisitions they did. So 3.4% is not the end of the world. But again, it's not my favorite tenant ever. And that's just the way it is. And I'm sure they can lease them to other tenants if they do close. I mean, they have good properties. And in terms of realty income in general, it's a mega cap stock or a large cap stock, you could say. And sometimes you worry that they can't keep on growing forever. But for realty income, they just keep finding a way. And I've been very impressed by the management. They've been finding a lot of opportunities in the UK and in Europe. And they have a total TAM, total addressable market of $8.5 trillion in Europe. And they don't face as much competition as they do in the United States. They've been finding good deals. And I'm very impressed by the management. They keep finding ways to do stuff. Pretty amazing. In terms of the dividend is almost 6%, 5.9% dividend, but it's not bad. 6% dividend is not bad at all. But this dividend is not the highest dividend growth ever. It's like 2.1%. Because unlike VC, realty income can do many more acquisitions. They can do acquisitions in Europe, in the United States. They acquire stores, they acquire data centers, they acquire hotels. They could do so many acquisitions. VC is really stuck with doing whatever they do in terms of hotels, which they just can't keep on doing it forever in terms of casinos and resorts and other things. So that's why they invest more in dividend growth and returning value to shareholders. Realty income does return value to shareholders, but they focus more on acquisitions. And I like that very, very much. So the dividend growth is only 2.1%, and I believe it's safe. In terms of the maturities, they don't have the best debt profile ever. They have a lot of debt due in 2026. But again, I'm not really worried about realty income. I mean, the stock is not going to zero. They have a lot of assets. They can always push it off to another date. I don't think it's going to cause them a lot of problems. Now, of course, if interest rates don't come down by 2026, then they are in some kind of trouble, you could say, and they would have to refinance at much higher interest rates, increasing interest expense. But rates will likely be lower from now till then, and they could do something about it. But in the near term, the dividend is safe. It's been growing it for years and years, and I don't think it's going to cut it anytime soon. In terms of their return, they calculated the same way I calculated, and this is a 6% dividend, which is what approximately this stock is offering. And then you have the 2% internally generated AFFO growth, meaning the leftover of AFFO after they pay the dividend, they use it to do acquisitions, and then the rest they issue some stock and they create more value per share than they issue. In total, it's 8 to 11%. I would say a safe 10% return. 6% dividend, 4% AFFO, just like VC. This is a 10% annual return on the realty income. And the best part about it is that realty income has a long way up to go. if interest rates do come down, because it's a little bit riskier than VC, even though it's diversified. But realty income doesn't have 41 and a half years. And this is why there's more uncertainty, which creates an opportunity, which creates a massive multiple expansion whenever interest rates ultimately come down. If the real estate sector is still fine, of course. And I don't believe realty income is going to be as affected as a lot of people believe. But it's trading at 12 times, the lowest it has traded at since COVID, since March 2020. The mean was 18 times. The company traded as high as 24 and a half times. I don't think we're going back over there, but I could easily see it going back to 18 times. So you don't only get a return of a 10% annual, but you also get a potential multiple expansion from 12 times to 18 times AFFO per share. This is a good return. This is why I like VC and I like realty income. VC is more safe. It's more of a easy money stock, safe investment. Realty income is a little bit more risky, but it's also a good return. And again, I would stay away from office REITs as much as possible unless they're in an amazing location that people just can't replace, irreplaceable properties like Empire State Realty Trust and others. And this is what I think about REITs. I like them so far, and that's my two favorites. It's not financial advice, of course, just my opinion on REITs and the market. Thank you again for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.